This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're now going to look at pricing, and there's quite a lot to get through here, even though it's quite enjoyable. So I will break the lecture down into 2 or 3 separate lectures. But first of all, it's obviously one of the key decisions that management accountants have to make, determining what's a sensible selling price for our product. You know, on the one hand, we want to charge as much as we can, but get maximum profit, but we've got to watch things like competitors and so on if we're going to be able to sell. And essentially, there are 3 areas which we should be considering. Paragraph 2.1, if you like, the 3 C's. We need to consider costs. Obviously, not always, but in any normal situation, you want to make sure that you're selling at a price higher than cost in order to be profitable. We need to consider competitors. In that, if we have competition, then if we're selling at a price higher than our competitors, clearly there's going to be problems unless we can convince people that our product is better than the competitors. And thirdly, we need to consider customers. We'll come to look at each of these separately shortly, but certainly customers in the sense that for many products, the higher the price, perhaps the less they'll buy. The lower the price, the more they'll buy. Well, that's again something we need to take into account. So it's really those 3 areas that need to be considered when determining a selling price. It's not everything, but they all fall into that, but the cost of production and so on. But also how much, when we come back to customers, how much disposable income do they have? How much can they afford to spend? How strong is our brand? If you've got a very strong brand, obviously potentially we can sell at a higher price than if we haven't. So lots of factors, but the ones we need to focus on really are those 3. And if you turn over, certainly what used to be very common way of pricing is what we call cost plus. Well, with cost plus, we simply calculate how much it's going to cost to produce and then add on a fixed percentage. And so in the old days, before lots of competition and things, that used to be very common. These days, less common, although restaurants, certainly if you buy wine in a restaurant, it does seem to be cost plus about 200% or something. You know, buy the same wine yourself in a supermarket, it tends to be a lot cheaper. I don't want to go on and on about cost plus pricing because it is pretty obvious. The main thing is whether you use cost plus or marginal cost. And before we just say advantages, disadvantages, if you look at exercise 2, and then we can tie it into numbers rather than just talking blindly. Let's look at exercise 2 with me. A new product's being launched and the following costs have been estimated. Materials, labour, variable overheads. In addition, there are fixed overheads, 50,000 a year, and the budgeted production is 10,000 a year. And he says calculate the selling price based on full cost plus 20%. Well, full cost is the full absorption cost, and so we do our cost card. Materials, $10 a unit, labour, $8, variable overheads, $5. And to get the full cost, we'll absorb the fixed overheads. He says we've estimated there'll be 50,000 a year. We've budgeted on production of 10,000 a year. And so on that basis, we absorb the fixed overheads at $5 a unit. And we'd end up with a total absorption cost or a full production cost of $28. And if our policy is to sell at full cost plus 20%, We'll add on our profit margin of 20%, $5.60. We'd sell at $33.60. Now that's fine, it's nice, easy, standard policy, again, that could be a benefit. Lots of products having a standard policy about fixing the selling price. But I'm not going to turn back, but in terms of advantages, disadvantages, an advantage, of course, is that subject to what's coming, we are guaranteed to make a profit. We've brought in full costs, fine. Every unit will make a profit of 560. We are going to be profitable. However, the downside, first of all, we've completely ignored competitors. If competitors are selling at $30, then of course it may be impossible to sell at $33.60. But secondly, this business of absorbing that we've assumed will produce 10,000 units. If we end up producing more, if we ended up producing 20,000, fixed overheads would only be 250, the cost would be lower, we could afford to sell at a lower price. On the other hand, if because we're charging a high price, it turns out we only sell 5,000 units, then, of course, fixed overheads are absorbed at $10 a unit. And that selling price would end up losing money. And so there's a huge problem. We're only, if you like, guaranteed a profit at 560, provided not only are people prepared to pay 33.60, but that we do actually produce 10,000 and sell 10,000, obviously. And so the other standard cost plus approach that superficially ignores that problem is marginal cost. And it says, suppose we instead have a policy of marginal cost plus 40%. Well, the marginal cost is just the variable cost, materials 10, labour 8, variable overheads 5. And so the variable cost per unit is 23, the marginal cost. And if our policy again was simply down on a fixed percentage, this time what does it say, 40%? Can I do that in my head? 920, I think. 23 times 0.4. Yeah, 920. We'd fix a cost on this a selling price rather, on this policy, a selling price of 32.20. Now again, in one sense that's very nice. If we've got lots of products, we have a standard policy, it's nice and easy to operate. But yet again, it's ignoring the competition. If competitors can sell for 40, why don't we sell for 40? If competitors are selling for 30, how do we hope to sell at 32.20? And the other problem, though, is that, of course, although superficially it looks as though we've avoided that problem I mentioned with absorbing fixed overheads, the problem is that we'd have to have a higher profit margin, a higher percent added on, because, all right, we're getting a contribution of 920, but to be profitable, we still need to cover the fixed overheads. There are still fixed overheads of 50,000 a year. And so depending on how many we do manage to sell, the question is, will the 920 a unit cover the fixed overheads or not? So either approach has a problem. And these days, to be honest, is a lot less common because of the extent of competition, if nothing else. But still, they still exist, and there we are. As mentioned there of opportunity cost plus, that's marginal cost again. But we look at the relevant costs. Well, I think we spent enough time talking about them in an earlier chapter on, I think it was on discounted cash flow. Okay, well, One other thing, though, that I said at the beginning, and I mentioned again as we were doing those two, is that another thing we need to bear in mind is the customers. That as we have a higher or lower selling price, does depend on the product, but very often a higher selling price means we'll sell fewer units. A lower selling price will mean we sell more units. Now, I'm not talking here about, a low price, we can steal business from our competitors. Even if we were a monopoly, we're the only producers of the goods. Well, again, it depends on the nature of the product, but if you charge a high price, it's likely people will buy less. You know, chocolate isn't a necessity. And even if we were the only chocolate manufacturer in the world, if you start increasing prices, surely people are likely to start economizing and buying less because it's not a necessity. On the other hand, if we reduce prices, something like chocolate, I think they're quite likely to buy more. And so we are going to have what you might call a trade-off. A lower price will obviously mean less profit per unit. But if we sell lots and lots of them, it might be a high total profit. Charge a high price, well, even though maybe a high profit per unit, if we don't sell very many, the total profit may be lower. So I think you see what I'm getting at. As that's something else really we would want to try and take into account. And then on the next page, it's ended up economist's viewpoint. Because it is, as you'll see, the way we approach it is rather theoretical. The idea is very practical, but the way we put numbers to it is perhaps not. But this idea that the higher the selling price, potentially, the fewer units will sell. Now, I don't know, that page makes it look overcomplicated with that graph and the equation that. But I think when I show you with exercise 3 what we're talking about, I think it's a lot more obvious. We assume, the one bit I will refer to the graph, very theoretical, but we do assume this business about higher price will sell fewer, lower price will sell more. We do assume that if we had price per unit against the level of demand, we assume that the relationship is linear, that at a very high price you'll sell none. Oh dear. As you reduce the selling price per unit, that will sell more, or vice versa. Higher price we sell less, lower price we sell more. Now, of course, in real life, okay, I keep saying it depends on the product, but in real life, you would expect very often lower price, sell more units. But I don't think you'd expect it to be linear. You know, it's more likely to be some sort of curve. But for any arithmetic that follows, we are going to assume it's linear. And if it is linear, we should be able to derive an equation relating the selling price per unit to the demand. And the equation is always of the form P is A minus BQ, where P is the selling price per unit and Q is the demand. So, for example, we'll do it on exercise 3 in a moment. For example, I may get an equation of 20 minus 0.1 Q. And what would happen is the higher Q gets, the higher the demand. Well, it's 20 minus 0.1 Q, the lower the selling price would be. That is a linear equation with no powers, with no q squared, p squared or anything. But you could be asked, you could be given information and asked to derive what we call the price demand equation to get values for A and for B. And let me show you with exercise 3 how you could be asked to do that. A company sells an article at $12 per unit and has a demand of 16,000 units at this price. We've decided, or we've discovered, that if we were to increase the selling price by $1 a unit, demand will fall by 2,500 units. So higher price, lower demand. We do assume it's linear, and so for every dollar we increase price, demand will fall by another 2,500. But equally, because it's linear, if we were to reduce the price by $1, it would go up by 2,500. And again, we want to find, on the assumption it's linear, an equation of that form. Now, I'll do it two ways. The first way, hopefully, just to make it clear what's happening. But then I'll give you what you might call the rule, whereby you can find the equation much quicker without wasting time. When I say, well, I will show the first way, but this isn't normally the way I would do it in an exam. It's just to hopefully convince you of what's going on. What is it at the moment? At the moment, P, the selling price, is 12. It's equal to A minus B times the demand, 16,000 B. The question says, if we increase the price by $1, so if the price went to 13, well, that'll be equal to A minus the demand will fall by 2,500 units. So instead of selling 16,000, we'd sell 13,500. I have two equations there in two unknowns. You should, from previous studies in different situations, be able to work out now values of A and B. You could do it lots of ways. I'll do it the way I always do it. It doesn't matter, there's only one answer. If I subtract the first equation from the second, term by term, 13 minus 12 is 1. A minus A is 0. Minus 13,500 minus minus 16 is minus 13 plus 16. It's plus 2,500B. So B, 2,500B is 1. B is 1 over 2,500, or if you prefer, 0.0004. And having got a value for B, you could now go back to the first equation and get a value for A, because 12 equals A minus 16,000 times 0.0004, A minus 6.4, and therefore, adding 6.4 to both sides, A is 12 plus 6.4 is 18.4. And so my price demand equation, P is A, 18.4 minus point B, 0.0004 Q. Now, I hope that makes sense. And by all means, if you're asked something like exercise 3, by all means do it that way. There is the answer. I think slightly more efficient, though, for that equation we're after, B is A minus BQ, B is always going to be equal to, it's effectively the slope of that curve, of that line. B is always going to be equal to the change in price over the change in demand. And so here it said, for every $1 change in price, the demand changed by 2,500. 1 divided by 2,500 is 0.0004. A, again, I'm only writing down effectively what I just did in my arithmetic, but A is always the current selling price plus B times the current demand. And so the current selling price is 12. B is 0.0004. The current demand is 16,000 units, which hopefully are exactly the same as before. Is 12 plus 6.4 is 18.4. So again, there is the price-demand relationship. And 18.4, in fact, is the maximum selling price out of interest. Remember, assuming it's linear, and if it is linear, if you think back to my little graph, the maximum selling price would be when demand was 0. And of course, if demand is 0, look at the equation. If demand is 0, the selling price is 18.4. And then more and more demand, lower and lower selling price. So that could be an exercise on its own. Although shortly we'll look at another exercise where we will actually need that price-demand equation. However, let's carry on. Whether we've got a linear relationship or we haven't, I think you agreed with me earlier, we can have that situation, you know, a monopoly. So forget competition here, whereby lower selling price, higher demand, higher selling price, lower demand. And what we want to do is decide on a selling price that gives maximum profit. And there are two ways you could be asked to do this. The first way, I think, is very easy. Just takes a bit of time with the numbers. It's what we call the tabular approach. And look at exercise 4. Kennedy has established that the price-demand relationship for whatever they're selling is as follows. If we charge 16 a unit, we'll sell 100. If we drop the price to 15.5, we'll sell 200. To 15, we'll sell, and so on. But dropping the price, I kept saying, it's going to sell us more. Kennedy's also established that the cost per unit is as follows. That if they sell 100, if they produce 100, it'll be 14 a unit. But if we produce 200, the cost per unit drops slightly to 13.9, 300, and so on. Perhaps it's because we're using absorption costing and the fixed cost per unit are lower as you produce more. Or perhaps it's just things like discounts because we're buying more. And our job is to decide which selling price will give us a higher profit. And you have a little table there. Let's do it. Fill in the table with me. First of all, if the selling price per unit, let's start with the maximum, 16. Our demand will be 100 units. And from the second table, if we are selling and therefore producing 100, the cost per unit will be 14. How much profit will we make? Well, of course, I could write it straight down, because you're making $2 a unit. 100 units is 200. Now, by all means, do write it straight down. But because of something I want to show you later, I will work out separately. The revenue we'll make 100 units at $16 is $1,600. The total cost, 100 units at 14 is $1,400, and therefore the profit, the difference, $200. Now, for the minute, ignore the last two columns. I'll show you what they are later and explain why I'm going to do them. So again, I repeat, I'm not stupid. I could have written 200 straight down. It's $2 a unit, 100 units. But I'll stick to this way, it won't take long. What happens if I drop the price? If I drop the price to 15.5, we'll sell more, we'll sell 200 units. The cost is a little bit less at 13.9. But as a result, the total revenue, 200 at 15.5, is it 3,100? Yes, it is. The total cost, 200 at 13.9, is 2,780. And so the profit, the total profit, one less the other, is 320. And so this is the point I was trying to make earlier. You see, we were making $2 a unit profit. We were charging 16. Drop the price to 15.5, and how much are we making per unit? We're now only making $1.60 a unit profit. But because we're selling 200, it's worth making less profit per unit, sell a lot more, because the total profit is higher. And of course, it's simply repeating it. So let's carry on down the table. Sell at 15, we'll sell 300, so the revenue will be 4,500. Produce 300, and the cost will be 13.8. 4,140. And more importantly, what happens to the profit? 360. And again, I won't bother checking, but the profit per unit is in fact lower than before, but it's worth making less profit per unit because we're selling a lot more units. Drop again to 14.5, and we'll sell 400, so the total revenue $5,800. Cost per unit, sorry, we're producing 400 now, so the cost per unit falls to 13.7. 5,480. And the profit falls to 320. Now then, in this sort of question, which is very theoretical, because things are moving smoothly, you can see the price keeps going down 50 cents and the demand keeps going up 100. And certainly in any exam style question, the profit will go up as it did, and then it'll go down. And in fact, we could stop there. However, because I want to show a few things out of this, I am going to finish off the table. There's not much left. So drop to 14, we'll sell 500. So the profit goes up to 7,000. The cost per unit, reduce 500, goes down to 13.6. So total cost is 6.8. The profit drops to 200. Only two more. Drop to 13.5. We sell 600. Revenue goes up to 81. The cost, if you produce 600, is 13.5 a unit. 81. So the profit drops to 0. The only remaining selling price available to us is 13. 700 units. Revenue 9.1. Oh, sorry, the cost 13.4. The total cost, therefore, 9,380. A loss of 280. Now, we're not given any more selling prices, so those are the only options. And you can see what's happening. I hope I've made it clear that although in each case the profit per unit gets smaller, because we're selling more units, profit doesn't always increase, but it can be worthwhile selling at a lower price because you sell more. We want maximum profit, and there is the maximum, and we'll achieve it by charging 15 a unit. We could charge a higher price per unit and make more profit per unit. We could charge a lower price and get more revenue. 13 would give us more revenue, but for maximum profit, the selling price, we'd fix the selling price at 15 a unit, and we'll get to 360. Now you can see why I call this rather theoretical pricing. The big question is, of course, how would you get all this information in real life? Not market research and things, but even so. But it's highlighting the importance of looking at the effect on demand. Because again, with so many products, raising or lowering selling price will affect demand and therefore total profit. Now, if you were given a question like that, then to do anything else would be rather silly, and I could have speeded up slightly. I said at the beginning, I could have simply said, oh, it's $2 a unit, total 200, I don't care. And also, because in this sort of question, it is going to be a sort of smooth relationship, I could actually have stopped there as soon as I realised that the profit had started to fall. In real life, it could go up, down, anything, but not in a sort of theoretical type question. However, although I wouldn't do it here in an exam, because of something that's going to follow, another way this sort of question could be asked, I am going to explain and fill in at these last two columns. If you look at the table in the notes, there's a column for marginal revenue and a column for marginal cost. So please don't misunderstand me. In this question, we would be wasting time to fill in these columns. But for the time it takes here, it will help you understand, hopefully, something we're going to do shortly, where it's the same sort of problem, but as you'll see, we're going to do it algebraically. And what it is this. We start again at the top, and we say, okay, if we sell at 16 a unit, we will make a profit of 200. That on its own is worthwhile. We then say, is it worthwhile dropping the price to 15.50? Well, it's worthwhile if we make more profit, obviously. And imagine now we haven't got the profit column. Imagine that's not there. If we drop the price, we will get more revenue. We're already getting 1,600. Drop the price and the revenue goes up to 3,1. The extra revenue, or the marginal revenue, we get an extra 1,500. So dropping the price by 50 cents will give us 1,500 more revenue. At the same time, though, it will increase the costs. We're already spending 1,400. If we drop the price, we'll be producing more. There'll be extra costs. The extra over marginal cost is 1,380. So remember, charging 16, we did make a profit, fine. We're now saying, is it worth dropping the price? Well, it's worth dropping it if the extra revenue we get is greater than the extra costs. And it is. It is worth dropping the price. If the extra revenue is greater than the extra cost, we're going to make extra profit. So we will drop it to 15.5. And obviously, I said, imagine the profit column's not there, but we have made that extra profit. It was 320. So we then say, is it worth dropping the price more? If we drop the price from 15.5 to 15, we'll get more revenue. It was 3.1, it's now 4.5. So the revenue goes up by 1,400. Doesn't go up as much as before, but it's gone up. What about the costs? The costs were 2,780. Drop the price by 50 cents, they've gone up to 4,140. So the extra over marginal cost is 1,360. Is it worth dropping the price? Well, it is, provided the extra revenue is more than the extra cost, we'll make extra profit. It is, so it's worth dropping the price. So we're now down as low as 15. Is it worth dropping to 14.50? We'll get extra revenue. The extra revenue, 4.5 up to 5.8, an extra 1,300. But of course, with extra costs, it goes up from 4,140 to 5,480, an extra 1,340. If the extra revenue is more than the extra cost, we've got extra profit. But here, the extra revenue is less than the extra cost. And therefore, that would reduce our profit. It's not worth dropping the price. And therefore, we'd stop at that stage. Again, the optimum selling price will be 15. In real life, anything could happen from then on. However, in theory, everything will move smoothly. And so we don't need to continue, because from then on, extra revenue would be less and less in each case. Extra cost would always be more than extra revenue. We've found the maximum. Now, can I repeat, if you've forgotten what I said earlier, to do that in this question wouldn't be wrong, we only have the same answer, but really would be wasting time. But I've not done it to waste your time. It's because of something that's coming. And well, let me explain now before I stop this lecture, and then we do the algebraic version later. If you're given a question, anything like that, then, all right, effectively do it as a table. And you assume the only available selling prices are those listed, 16, 15.50, 15, 14.50, and so on. But I think you'd accept, in real life, even if we did have all the information, you know, why should you be restricted to 50 cents? Why couldn't you keep dropping the price by 1 cent? And so although of our choices, 15 is best, oh, maybe $14.90 might be better. Or $14.80. I think you see my point. Now, we don't even consider them here because whatever prices you're given in the question, you assume they're the only ones available. But do see what I was doing in those last two columns, that always, even if you could keep dropping the price by a cent, if extra revenue is more than extra cost, it is worth dropping the price. Even if the difference is only $1, it'd be $1 more profit. But the minute extra revenue is less than extra cost, it's not worth doing. It then starts to lose money, even if it's only $1. The point to get from this, not for this example, but for what's coming in the next lecture, is that in theory, the maximum profit will occur when marginal revenue equals marginal cost. If revenue is more than by marginal cost, even if it's only by a cent, it's giving you more profit. If marginal revenue is less than marginal cost, even if it's only by a cent, it gives you less profit. The maximum will be when those two are equal. Now, I hope that makes sense. I'll show you again in the next lecture. I'll do a little graph which I hope will make it even more sense. But although that statement is not relevant for exercise 4, it'll be very relevant in the next exercise, when, as you'll see, we're doing the same sort of thing, but we're going to do it algebraically. So we'll have a break there, but in the next lecture, we'll look at the algebraic approach to this economic pricing, or this theoretical pricing.